Good afternoon, everyone. This is Doug Cha, the Executive Director at the Governance Center here at the Conference Board. Welcome to another episode of Governance Watch, a webcast series we've been doing with our partners at Cleary Gottlieb, Steen & Hamilton law firm. Today we are going to be talking about PIPEs, private investment in public companies. This form of investment was widely employed in the wake of the financial crisis, and it can be an effective tool for smaller enterprises, especially to attract new capital. Today we're going to give you a broad overview of PIPEs, learn what they are, how they work, pros and cons, and also have some discussion about the recent and possible future trends for PIPE transactions. Pleased to be joined by two accomplished attorneys from Cleary Gottlieb, Adam Fleischer and Bennett O'Reilly. Adam is a partner at Cleary Gottlieb here in New York, focusing on international and U.S. capital markets offerings, and he advises asset managers on investing, structuring, and trading issues. And Bennett O'Reilly is also a partner at Cleary in New York, focusing on public and private M&A, private equity investments, and restructuring transactions. So guys, thanks for being here. Before we jump into our discussion on PIPEs, let me just cover a couple of housekeeping notes. We are offering CPE and New York CLE credit for participation in the live program. To get credit, you need to stay on for the entire webcast. For CPE, there's a box for you to enter your full name, email address, and specify CPE in the request CPE credit space at the bottom of your screen. There will be 3 pop-up messages during the course of the program for you to click and confirm your participation. For CLE credit, you need to download the CLE verification form and the CLE evaluation posted in the download section at the bottom of your screen. Complete them and send them back to our friends at Cleary Gottlieb. There's an email provided for you to do that. Later in the program, I will provide the verification code, which you'll need to write on the form to earn the credit. And then there's also an accompanying slide deck related to today's discussion that's available at the download section on your screen. We do encourage audience participation, and there is a box on the screen where you can type in questions. I will see them and incorporate them into the discussion. You can enlarge your screen to full, or enlarge the video to full screen by clicking on the 4 arrows in the upper right-hand corner of your screen. Please do fill out the evaluation form and send it back to us, or enter it online. It's very helpful for us for future webcasts. And finally, we will be posting a replay of this webcast for you to share with your colleagues and watch at your leisure. So now I want to turn it over to Adam and Bennett to talk us through PIPE transactions. So, maybe one of you want to talk about, what is a PIPE transaction? I'm sure a lot of people tuning in just really want to understand what that is.
Sure. Well, as you suggested and as the name implies, PIPE stands for Private Investment in Public Equity. So the premise is that you have a public company and it's going to be doing a private placement of securities. And that's really all that all that's encompassed by the concept. So it's a very flexible notion. We're going to go through today in considerable detail all the different varieties of pipes that are out there and all the purposes for which they can be used. Because of that structure, though, they can be done very quickly, they can be done confidentially, and they can often be done cheaper than a public offering.
Okay, so it sounds like, right there you listed a couple pros of why a company would want to do a PIPE transaction. Any downside, or there's got to be some downside in terms of why this isn't done very often?
I mean, I think maybe to start just going back to the pros, because I think it's useful to,
Yeah.
to focus in on them a bit. It really is in a situation where raising capital through the public markets is not going to be ideal. I think the pricing benefit is useful. You avoid an underwriting discount, but I think there are other costs embedded in these types of transactions. So it's hard to determine whether there's a pricing benefit, but it really is the ability to do things fast, particularly if you have a company that doesn't have a shelf registration statement available. If they want to raise capital quickly, a pipe can provide them that avenue if they want to be introduced to new investors. In my world, I'm principally an M&A lawyer, and the situations that we see pipes the most are areas where you're trying to do something, a company is planning to do often an acquisition or some other type of strategic transaction that's going to require capital that they need to provide, for example, assurances to the target company that they're going to have the capital available. And so they have to raise capital at a time when it's impossible to actually go to the public markets because you have this highly confidential event that is not yet public. And this allows you to approach investors, to share non-public information with them, and to get them to invest. So speed and confidentiality, I do think, are the two.
Yeah, I think the same is true outside of the M&A context. If you have an issuer that's looking to raise capital, may not have a shelf available for a variety of reasons, it may want to test the waters and see if there's investor appetite. All of it can be done on a confidential basis without telling the market that you're interested in raising money, which can, of course, have a downward effect on the stock price.
And what's the typical profile of a company that would issue pipes? Other than in the M&A context, from a capital markets perspective, what is that?
I think it varies.
Yeah.
Historically, they were very popular in smaller sized companies, biotech, pharmaceutical, companies that had volatile results or had milestones, life cycle events, needed to raise some capital quickly around those events. I think in recent years, particularly as you mentioned, since the financial crisis, they've become a tool for all companies. Companies that are knocked out of the public markets for whatever reason, they can be done in a very large size. As the name suggests, it's just a structure, so there's no inherent monetary limit to it. And indeed, during 2008, 2009, we saw companies that wanted to raise money quickly, maybe from a small group of holders, wanted to do it without a large public profile, and use pipe transactions to achieve that. The other thing that we should mention up front is that it's just a private placement of securities, and they're often done for common equity or for convertible preferred, sometimes for convertible debt. But you can really structure the instrument to be as simple or as complicated as you want it to be. So if you have hedge fund type investors who are looking to do a quick investment and maybe get quick liquidity, they might be buying a more vanilla instrument that's fungible in some sense with listed security, subject to getting registration rights. In the context of an M&A deal or a bit more bespoke situation, more of a long-term investment, you may see much more structured solutions come into play.
And so when you talk about speed, obviously when you're doing deals, there are a number of things that have to happen, with securities offerings. One of those is dealing with the SEC. So maybe talk a little bit about how that's different from your typical securities offering.
Sure. In a typical securities offering, you have to have a registration statement on file if you want to offer the securities to the public. In this context, for a variety of reasons, the company may not have a registration statement that's ready. They may not have a shelf up. They may have financial statements that aren't quite up to date, and they may need capital quickly. So here we're operating on a private basis, completely outside the realm of the SEC process. Now that inherently means that you're limited to dealing with accredited investors, which means that the investors generally have an income of a few $100,000 or a net worth of $1 million, or they're institutional investors. That's still a pretty large pool of investors, and indeed this is often an institutional market, or at least a high net worth market, but still a pretty vast pool of capital on the buy side. And what it means is that you're confidentially approaching your potential investors. They're agreeing not to trade on the possibility of the pipe because you're sharing information with them, and even the possibility of the deal is often material, non-public information. So they get locked up in trading the company's securities for a specified period of time. And you have a discussion with them about the potential terms of the offering. If it's a simple offering, you might say, well, I'm going to sell you common stock. The common stock is trading at $10 a share. They say, I'm going to give you a discount because as a result of it being a private placement, the investors are going to take restricted securities, which means they can't be freely resold right away. So they'll need some accommodation to facilitate the resale, which means usually resale registration rights or waiting until they're permitted to freely resell them under Rule 144, which generally speaking for non-affiliated investors, it gets a little technical, means about 6 months.
The other, sometimes there's another step or shareholder approval. So, is this something that requires shareholder approval in certain circumstances?
So if you're listed on the NYSE or NASDAQ, you can't issue more than 20% of your outstanding shares in a private transaction unless the price is above market, or the greater of book and market. There are also limitations on your ability to issue shares to somebody who become a controlling shareholder, which for NYSE purposes is a little bit unclear. For NASDAQ purposes is anybody who would own more than 20%. So in those situations, your ability to do a PIPE may be limited, and so you have more flexibility in a public transaction, particularly as Adam says, in a PIPE, you often are pricing below market in order to induce people to buy securities that will be restricted. In the strategic context where there are often tools that people use to structure the transaction so that the securities that you're issuing may not be entirely fungible with the public equity, but may only be fungible after you've obtained shareholder approval. So there can be staggered issuances, or you often try to keep it below that 20% threshold.
Got it. So let's talk about who invests in pipes. You mentioned accredited investors, hedge funds. So talk about a little bit the profile of who invests and why they invest.
I think the profile varies tremendously, again, with the type of situation and the circumstance. For a traditional pipe where the company is simply looking to raise capital very quickly, the typical investor is looking to get liquidity quickly, and it's not a complicated long-term investment. So there's really not much to structure. The investor is looking to get something that is either common equity or converts pretty readily into common equity, coupled with registration rights. Those investors tend to be hedge fund investors. They might be mutual fund investors. There could be high net worth investors, and so on. In a situation where a company is looking for a more strategic relationship where the investor is, there it might be a private equity firm, might be a venture capital firm, or a strategic investor that wants to have a relationship with the issuer.
Got it.
An example of that could be like in the biotech or pharma context, where you have often large pharma companies that are looking to make investments in smaller companies to develop products, to enter into licensing agreements, and often in connection with those, they'll agree to make an investment to demonstrate their support and belief in the company, to give them capital to be able to sort of take that idea to fruition.
And then the M&A context, what are kind of the different things? I mean, obviously it's going to be case by case, but what do you typically see, and what are bankers typically saying in terms of here's a situation where a pipe might make sense?
I think it's it'll depend on what you need for in the M&A context. If you're an acquirer trying to buy something, often you can finance it with debt, and so you wouldn't necessarily need to go out and raise equity. Also, often, if you're a big listed issuer, you can get a commitment letter to provide you with a bridge loan that you'll plan to replace with equity between signing and closing of transaction. I think you would do a pipe in circumstances where either you don't have that much access to capital, and so you absolutely need to raise more equity, and you can't demonstrate. You wouldn't want to put yourself in a position where you'd be hung up in a bridge. If you want to ensure that you get the right pricing, and you don't want to have the uncertainty of where your stock will trade after the announcement of the deal before you can get an offering done, you can price it based on the pre-announcement price. I think those are typical situations.
Got it. Maybe Adam, you want to talk a little bit more, get into the technical aspects of how these, how the pipes work as a security.
Sure. So just to kind of step through the process, in a standard deal, you would confidentially approach investors, and that might be intermediated by a placement agent. You would get them to agree to keep information confidential. If the idea is that you want to give them liquidity relatively quickly, you're probably not going to share that much material non-public information about the business with them. It's more the fact of the deal that's the most material fact that you're sharing. So those investors will not be locked up for a long time. Either the deal will go forward or the deal won't, and then they'll be free to trade once that decision is made. They'll commit to keep it confidential, sign an NDA. You'll negotiate the terms of the pipe. Sometimes that'll be done either through the placement agent or it'll be done through a lead investor together with their counsel. There'll be a purchase agreement that lays out the terms of the security, and there'll be a date set for closing, like in most offerings where the money and the securities switch hands. Importantly, as I've alluded to a number of times, there'll be a registration rights agreement typically, where the issuer is committing to register for resale the securities that are placed with the investors, so they know that they'll be able to sell them in the public market after a specified period of time.
And is that registration rights, is the registration statement, is that a condition to closing to get that registration up or not?
It can be. Traditionally, that's how pipes were set up, where the SEC had to be ready to declare the registration statement effective, which it only would do if investors were completely on risk. I think as the market has evolved, typically the obligation comes after the closing. And that's for a variety of reasons. I think part of it is just pipes being a little bit more sophisticated, investors having a slightly longer time horizon, the availability of Rule 144, which has been modified in the last 10 years to bring down the period during which investors have to hold before they can freely resell. It used to be a year, now it's 6 months. So a number of changes that have happened in the market to gravitate toward that outcome. Of course, if you're talking about a more structured context, then it may not go as quickly as that, and there may be a tremendous amount of negotiation around how the instrument is going to look, what all of the ancillary rights are, what the broader governance connections are that are going to be put into place, and so on. So it's really context dependent.
And so maybe what are some of the governance pieces of, and conditions that go along with pipes?
So I think in the kind of hedge fund, kind of capital raising context, they don't tend to be that much. You're really buying into the security. You might have some sort of lockup, but it'll be pretty short. Then you'll have the registration rights. So the expectation is you're providing capital to the company, but you're not coming in to play a role in the governance of the company. In the strategic context, or where you have a private equity firm coming in, then part of the attraction of the deal is, from the private equity firm's point of view and from the issuer's point of view, is getting some of that expertise that the private equity firm can provide to the issuer. And so in that context, I think both parties really want there to be a role in the governance. And so typically you would have a board seat or two, depending on the percentage of the ownership that the investment represents. And so you kind of, from the company standpoint, you gain the expertise of the private equity firm coming in. From the private equity firm, you'd have the context of having some oversight. You've deployed potentially a very significant amount of money. You want to see how it's spent. I think other things sometimes, and again, these would be in circumstances where the investment was very significant percentage of the outstanding stock. You would have further rights, veto rights over certain types of transactions. You have to be careful with those. We talked a little bit earlier about these shareholder approval requirements. One of them is, if you do an issuance that results in a change of control, that requires a shareholder approval. And so certain types of veto rights may implicate that, even if you don't own more than 20%. Say, for example, you have the right to veto the change of an executive officer or CEO. That might implicate a change of control. Those are pretty common. I think, sometimes you have different classes of stock. Sometimes you have voting agreements. There are different ways to implement this. But I think the board seat is really the main mechanism through which the investor gets their governance rights.
But couldn't some of the investors be, already significant shareholders? And, does it, so is that a different circumstance when you're offering pipes?
I think, it often happens that if you're trying to raise capital for a transaction, you likely will approach your existing shareholder base, particularly if you're trying to get something done fast, and you have a group of institutional shareholders who support the stock, who have been long-term holders, who understand the strategy. That's an opportunity to go to them and put them under NDA, tell them you're about to do something, and you need additional capital. And if there are companies that you have supported the stock, I think there are other situations where it may be an opportunity to bring somebody else into the stock. And so even outside the strategic context, it may be an opportunity to kind of look at your shareholder base, see who are you trying to attract, and to try to bring somebody in who, sometimes you just need capital, and you're okay with having short-term capital. But other times, I think it's useful to try to bring in somebody who plays sort of an anchor role in your capital structure.
In that context, you need to be careful sometimes, and you want to limit how much the investor can hold in the company. So sometimes you enter into a standstill just to make sure that they don't go above a certain ceiling. At the same time, you also may want to lock them up so they don't create downward pressure on the stock price. So it can be a fine art calibrating exactly where they come in and how long they're going to stay there. And those can be multi-year arrangements.
And so, Adam, you mentioned confidentiality of the transaction before, and signing people up into an NDA.
Mm-hmm.
I guess some people could say that, well, look, the fact that you're even contemplating, or that you're pretty far along in doing a PIPE transaction,
Mm-hmm.
is in and of itself, material, non-public information that says something about the company's, financial condition or something like that. Is that, how do you deal with that kind of information? Or is that even true?
No, that is true, and that's a little bit what I was alluding to before. Yeah. I think there's a distinction to be made between the deal itself being material and confidential information about the business of the company. In the context of the deal itself being material, you want to keep people confidential, because if people know that a PIPE is coming, that can exert downward pressure on the stock price, right? Just by virtue of the dilution. There's a second question, which is, does it also signal that the company may or may not be in trouble, right? And I think in the base case, which is just that the deal itself is material because you have dilution coming and the fundraising is opportunistic, then what investors care about is, okay, how long am I going to be locked up? Either the deal is going to be announced within a certain amount of time and the issuer will commit to that, or the issuer is going to decide not to do the deal and release investors from that commitment. And the theory in that situation is the fact that I decided not to do the deal was really just taking a pass on an opportunistic situation. It's not material. I don't need to disclose it. I'm going to stay out of the market for a while, let it kind of dissipate. In the situation where the company is in financial distress, it's not so easy to reach that conclusion. And if you can't come to terms with investors, I think you face a really hard question, which is, do I have to tell the market that I tried to do a deal and I was unsuccessful? And I think that's a real tension that people grapple with.
And there's a little bit of a delicate dance when you're trying to get people under NDA, even in the first place, when you have a potential transaction that you want to do, you want to attract investors, but you can't tell them about it until after they've signed the NDA. But you have to convince them to sign the NDA before you can tell them about it. And that, that gets played out in a variety of different ways, often depending on how sensitive you think just the fact that you're making these calls may be. And so we've been in circumstances where you're asked to sign NDAs without even knowing the name of the target company. And so that if it's incredibly sensitive, if anybody gets a glimpse of hearing that this person is looking for capital, it could impact the stock price, and you don't want to do that. So you might do some sort of no names NDA where you get the name after you've signed the NDA. Obviously, people
I think that's really common in the capital markets context, where a bank will act as an intermediary, will call the investor, and sometimes they'll call compliance so that compliance gets the information and the traders don't hear it directly. And say, we have a deal in the X sector. Are you guys interested in hearing more? Will you get restricted in the name? And typically the question back is, for how long? Again, it depends on the situation.
Yeah. Well, it's no wonder that these are limited to accredited investors who supposedly know what they're doing.
And it depends on the investor base. I mean, I think, in Adam's world, in the more capital markets, those guys do not want to be restricted for very long. And so they might agree to an NDA, but they'll want clear terms for how long it's going to last and how they're going to be sure that they're going to be able to trade. In the world I live in more the M&A context, working with private equity funds, they tend not to be trading actively in shares, and so they tend to be more willing they're looking for opportunities. That's not to say it's always, they necessarily want to be locked up, but they're more willing to consider things because it's not going to impact the rest of their business, their kind of day-to-day business.
And I guess it must create some timing issues. I mean, I guess you said these deals can be very quick, but if we're talking about public companies, they have a quarterly earnings call and report coming up. Questions going to be asked. Well, what kind of things are you contemplating? And you're contemplating a pipe deal. So at that point, I guess you've got to kind of get that over with well before any kind of earnings call.
I think that's right. You try to time these so
Yeah.
that they end up not. You don't want to have an earnings call and then announce the transaction 3 days later. Having an earnings call coming up often gives investors comfort that there is going to be this opportunity that is pretty soon where the company's going to have to disclose all material non-public information, and so that gives you comfort that you will be cleansed and be allowed to trade.
Got it. You talked about there are different securities you can be using for these pipe transactions. And so maybe just talk about, what kind of securities get used and for what reason and the kind of pros and cons of the ones that are pretty common.
I think the most common ones would be straight equity, again, for the reasons that I mentioned before, probably followed by convertible preferred. There just because it comes with a bit of a return and it's higher up in the capital structure, and if the holder wants, they can convert it into the underlying equity, which will be fungible with listed equity, and monetize the position. Sometimes you see convertible debt. Again, that comes with a specified maturity date, unlike convertible preferred, which might convert upon an IPO. Oh, sorry, thinking of pre-IPO. But convertible preferred doesn't have a specified maturity date usually, whereas convertible debt might. The advantage of convertible debt is that if done in a certain way, it can be done without putting a valuation. Thinking of pre-IPO also, again, people are using these techniques all the time. But again, it's just higher up in the capital structure, comes with an interest rate, which can be paid in cash or in kind. And it also can be secured.
I think for private equity investors, it's not unprecedented, but they would often prefer, they don't invest in the common. They're looking for a security that has some additional features. And so it will usually be some sort of convertible preferred, a preferred with warrant, or convertible note structure. That'll give them, it'll give them a senior place in the capital structure. It might give them some sort of guaranteed return to make sure that the company's performance, because they're committing, often to remain investors for quite some period of time. Unlike the people who are providing short-term capital who want the flexibility to be able to sell quickly, they're not committing themselves, they're not locking themselves up too much. Whereas the private equity investors are looking for something more than just straight common.
Yeah, more substantial.
What, in terms of lockup, what kind of periods are we typically seeing in these?
Well, I think they can range in the capital markets context. It might be very brief. It could be 30 days until the registration statement is effective and people are able to sell. Could be longer, could be 6 months. I think in the M&A context, it could be potentially even years.
Yeah, it's probably 1.5 to 3 years, I think would be.
Okay.
And again, it sort of matches, it should match a little bit what the strategy is. Like, why is this investment being made? If somebody is coming in to help a company go through some sort of transformation, you want to sort of match some of these terms up with each other.
Sure.
So you don't want somebody making a big investment for a transformation and selling out 6 months later when you have some bumps in the road.
Maybe talk a little bit about pricing and how the issue price of a pipe security might compare to the company's market price.
Yeah, typically if you're doing a quick hedge fund type investment, it's going to be at a discount to the market price. Maybe not a huge discount, but to compensate for the restricted nature of the securities. By contrast, I think in the more structured situation, it may in fact be at a premium because it's coming with all the other rights that we've been discussing. So it really depends. If you're getting board seats and so on and other arrangements that come along with it, you have to pay for those benefits.
And so, let's talk a little bit about those governance type rights that come along or that might come along with this type of security. You mentioned board seat. Is it always a board seat? Is it kind of a voting member of the board? kind of give an overview of that?
I think, on a private equity investor makes this typically a board seat. Sometimes what you'll see is you'll get a board seat and maybe an observer seat. Often that may be in circumstances where, the private equity investor wants more people in the boardroom, but the company's not comfortable with giving them the full amount that they may be requesting. An observer seat, they're not necessarily silent observers, but they don't have a voting position on the board. But they can be useful to sort of. We have some clients who candidly don't want a board seat. They may want an observer seat, but there are consequences to becoming a director in terms of at least potential liability for fiduciary duties, and if some clients, we represent some strategic clients like pharma companies who'd rather just prefer to have an observer seat. They're not looking to really be involved in the governance of the company. They're not really trying to shape it, but they might have made a big investment in it. They might have a big licensing deal with it, and so they want to to sort of be part of the discussion without making decisions. And so that's a good opportunity.
And it lets you monitor your investment in the best possible way, right at the board level. You can also couple board seats with kind of sell down threshold so that you own 40%, you've got 3 people on the board, 30%, you've got 2, so on. So there are sunset mechanisms. It gets complicated quickly.
Let's see, other governance mechanisms. I guess you have voting rights as well.
I think you would have voting rights. Again, it sort of depends on the type of security, but often to enforce, for example, a board seat, you might have a security that, like a preferred security, that has a direct right to appoint 2 board members. And so that the holders of that security, named like the private equity fund, has a direct right to vote on those 2 people, and then the rest of the common vote on everybody else.
I think the other feature that we haven't really mentioned is put and call rights, right? Liquidity options, exits, particularly when you're in the more bespoke situations, people want to know that there's a pathway to get out of the relationship. And so having some ability to call in the instrument or to put it back to the issuer can be very important.
And what about veto rights?
Potentially, if it's a very significant investment and you do have a lot of oversight over corporate action, then getting substantial minority protections can be very important.
Got it. Any other types of rights that investors might seek? Like you talked about registration rights, put and call. What about like preemptive or anti-dilution or anything like that?
I think preemptive rights, anti-dilution rights are very common. Sometimes you see price adjustments so that if there's a subsequent raise at a lower price, then you get the benefit of that price in some fashion. You sometimes see more complicated structures based on liquidity events in the life cycle of the company, and so on. But, yeah, those are common.
The ratchet provisions, they can be very dangerous for an issuer. There's kind of this, fear of having some sort of death spiral security that goes out there, because if you issue security and you have to raise more capital at a lower price, the prior people get to ratchet down. That means you're going to have to raise even more equity in order to because the equity you're issuing isn't going to be worth as much, and so it becomes a real negative cycle. So I think people are quite careful with how they structure anti-dilution protections. There are contexts. Adam mentioned the financial crisis. There were a number of securities done in that context where people just didn't know what the right price of particularly financial institutions were, and people weren't willing to invest without knowing that if somebody invested 3 months later, they weren't going to be able to invest in the same terms. I think in the more normal world, you have softer protections.
You would want to put in a floor in that case. I mean, the quintessential example of a death spiral would be a conversion price pegged at a discount to wherever the market price is. And then you have every incentive for the people who hold that to short the stock and push the company into a very distressed situation so they can pig out on the equity.
What about appraisal rights? Do those ever come into play?
I think that's much less common.
No, I think you mentioned preemptive rights. I do think in the strategic context or private equity, that's something that they would likely ask for. If you're making an investment and you're buying 20% of a company and you're making this big commitment to them, you want to have the opportunity, if the company's raising new capital, to deploy and to maintain the same level of ownership that you had. That would be quite common.
Got Um, let's see, at this point, I'm going to give the viewers for CLE the code to put on your form. It's 11488. 11488. So be sure to put that on the form before you send it in. On this show, we typically talk a lot about the board's role in all of this. So, if you're a board member or if you're, advisor to the board, what kind of discussions you're going to have with the board in the boardroom?
I think the key question for the board is why use this alternative as opposed to any other alternative? That's the most fundamental question. What's the value of this approach to the market? As we said before, it can be done quickly and it can be done confidentially. I think in the typical hedge fund type context or financial context, it can also be done cheaply. As I mentioned at the outset, you may pay a placement agent a little bit less because they're not actually underwriting the offering. They're just taking a percentage on the basis of the overall raise. I think in the context of a more structured transaction, it can be more complicated and involved, and the board is going to want to know why they should go down that road. So it's really fundamental decisions. Why are we doing it? What should we be thinking about? Advantages and disadvantages. And then making sure that you have the machinery in place to go ahead and execute. Do you have the authorized shares and so on?
I think you want to be cautious about, are you selling control? Obviously, in Delaware and other states, there's a heightened standard of scrutiny if you're going to sell control of the company. And so if you're selling to one investor or a very small group of connected investors, a significant portion of your equity, you're obviously giving them a place where they can exert control. And so you want to be, there are reasons you might want to do that, but unless they're paying a big premium, which they likely are not. We talked about pricing, may pay a little bit of a premium, but we're not talking about what would be the traditional M&A premiums that you'd be paying in this context. And so you want to neuter their powers. You want to make sure that this investment doesn't become an opportunity for them to springboard into further control of the company. And so that's why you would often have a pretty long-term standstill in place that will stop the investor from buying additional securities, from taking other actions that will be hostile to the board for running a proxy contest. And so the investor will get board seats, but then they can't try to seek additional board seats. And you might see situations where you'll ask the investor to vote with the board's recommendation, particularly on other directors, but also on some other matters that may be put to vote. That's always a negotiation because the private equity investors will often have views and may not want to go along with the rest of the market in terms of on an acquisition, M&A transaction, something like that. But that's something you'd want to think about. It's just not giving up control of your company without getting the right premium in exchange for that.
I think also you'd want to think about regulatory hurdles. We mentioned before stockholder approval. That's an obvious one. It's always front of mind. But when you're selling large chunks of the company, you may have HSR concerns. You may have Delaware 203 concerns. CFIUS has become increasingly of concern, top of mind. If you're in a regulated industry and you're selling more than a certain percentage or you're selling control, you may need to talk to a regulator, and that can have timing implications, of course.
And so for a sitting board member, any implications for them? I mean, would a sitting board member be part of the group? I mean, would they be buying or be given these types of securities, or does that really not come into play?
Not often.
Or I guess board members and executives.
I think it's not unheard of. There are some complications if you're issuing securities to executives. There are different voting thresholds that may apply. So you have to think about that in context of deals that are below market. And so you typically would not see existing board members or existing directors participating in pipes.
Yeah, that's fair.
And then in terms of some of the more kind of black swan type of governance events, so I guess whenever you talk about putting shareholder having the right to put somebody on the board, it can get contentious over who that person is. And I guess I take it that gets negotiated in terms of who exactly the person is in terms of coming onto the board, or is it basically the the shareholder pretty much just has the right to appoint whoever they want.
From the issuer standpoint, ideally you would have some sort of, there's obviously a range of different paradigms. Sometimes you might say you can appoint somebody, but we get to consent to who that person is. That would be, I think a little bit unusual. Often they would still have to go through the nomination committee process. There's usually somewhere in between, not full control, but also not the investor can just put on somebody who the company would have a genuine reason not to like. But I think if you're bringing in an investor, the reality is the first director who comes in, you know who they are. It's kind of part of the investment. But you do think about what happens, if that person leaves, they leave the institution, they go on to something else. Who's going to replace them? And the personal relationships can be quite important to these sorts of transactions.
I've seen deals where you set criteria that explain the person has to meet minimum qualifications and other standards for the director's spot. That's a way of doing it generically rather than specifically.
And there may be situations where, the board seats, it may be that you're concerned, you wouldn't want to give 3 board seats to one private equity firm just because you'd be concerned about the potential for kind of a small group in the boardroom to kind of dominate the conversation. But if somebody's making a very significant investment and that relates to sort of the portion of the company that they own, maybe what you'll do is you'll give them 2 board seats, but then give them 1 or 2 seats that they get to appoint independents. So it gives them, they get to choose who the person is, but it's not somebody who works for the institution. So they have a little bit more, they're going to be somewhat allied potentially, but they're going to be more willing to listen to others.
So is it typical to see, someone who works for the private equity firm or the hedge fund being placed, or somebody, kind of a third so-called independent director?
I would say more the former.
Yeah. And so I'm not sure this has ever happened, but what if that person gets voted off at the annual meeting? They get under 50%, et cetera, et cetera. I guess that's
if you have a nomination right, then you may have the right to nominate somebody
else in there.
Yeah. That's a whole different presentation, I think.
No, that would be pretty embarrassing, I can imagine. Let me see. And so, in terms of what the issuer cares most about, Bennett, maybe you want to talk a little bit about that.
Look, I think we've talked about it throughout. The issuer is in a circumstance where they need to raise this capital for a particular reason. Sometimes it's speed, and speed is what they care the most about, and that might dictate that they're going to think less about exactly who they're placing the stock with. There are certain investors you'd probably prefer not to have in your stock because that their goal is going to be to short, to get out, to do other things with. But if you don't have a choice and you have a need for capital that is very serious, you may not have the luxury of choosing your investor base. I think in circumstances where it's more of a strategic investor, then you're really trying to think about how is this investor going to help me? And it could be the expertise they bring, it could be other investments that they've done, expertise in the area, how they could help you, manage things that you're deficient on your board. Obviously, like private equity firms have a lot of experience with managing capital structures, going to the debt markets. Often they have a lot more access to that because they're constantly raising capital for their portfolio companies. And so that might be an interesting expertise. They may have worked with a company that has similar problems that you're facing. Maybe you're rolling out a huge new IT system and nobody on your board has the ability to really give oversight to what's going on. There could be different things that they can really bring. And so I think that's how you think about it. And then, obviously pricing is also a factor of it. So I do think, at the end of the day, especially in a strategic investor, I don't think the dollar amounts is going to be the last decision point, right? If you have people in a range, then you start to think, okay, well, this is a long-term investor. Maybe I don't take the best price available because I think over time, this investor is going to make this company more valuable because they bring much more to the board than the person who's willing to pay the most. In the more pure capital markets, I think price is probably more important.
I think price is important, and one technique that we should mention that people have sometimes used is when they do have a shelf available and they can't tap the public markets, they take pipe techniques and import them to the public context. And so they market privately, but then issue off of the shelf. So the investors don't take restricted securities. And those are called registered directs or confidentially marketed public offerings that go by a variety of names. Sometimes people call them public pipes. It's a little confusing, but you won't need to get as much of a discount there, right? Because you sold the market price. There's no liquidity due to the restricted nature of the securities, and it works out well for everybody because you get the confidentiality plus you get the quickness. But you do have to be ready to issue into the capital markets and have a shelf available in that case. That's a very common technique, or increasingly common technique.
Yeah. Adam, you mentioned Delaware Section 203. Maybe you want to just kind of give a summary of that for people who are watching who are not as familiar.
Yeah,
with
sure.
corporate law.
Sometimes we get too jargony. I think 203 basically stands for the proposition that if you have somebody that's going to cross the 15% threshold, they need board approval in order to do it. Otherwise, it's an anti-takeover issue. And so when I think about structuring a pipe, I step back and I think, okay, I've got my stockholder approval at 20%. If I've got a related party in there, it could be as low as 1% under certain NYSE rules or 5% under NYSE and NASDAQ rules. And it mentioned change of control. I think about regulated industries. I think about HSR. So you have to think about how much you're issuing, whether it's purely passive, whether there's a control aspect to it, and you want to just think about all of those different regulatory regimes that apply. Some companies have tax considerations. They have net operating loss limitations on ownership changes. It can get very complicated. So it's important to understand thoroughly the capital structure of the company and all of the limitations that there are on new issuance.
And I think at 203, for Delaware companies, unless you've opted out, which only a minority of Fortune 500 companies opt out, it means that an investor cannot buy more than 15% without board approval. Now, basically by definition, these transactions will involve board approval. They're not hostile transactions. But what it does implicate is if you want to think about it, is why is 15% important? 15% is important because once you get above 15%, once you get above 20%, you're drifting into the world of control. And so I think it just focuses the board on, we're going to be waiving 203 for this particular investor. What are we getting in return? What protections are we going to put in place in order to make sure that this investor doesn't use this control position to disadvantage the rest of the shareholders?
And so we talked a little bit about disclosure obligations for the issuer. What about disclosure concerns or obligations for the investors?
So investors have to think about large holder considerations, which typically are tripped at the 5% threshold under 13D. And that'll be familiar to most institutional investors. They'll know that if they acquire more than 5% of a public company, they're going to have to file a 13D or a short form 13G. I think the more interesting one is the 10% threshold in Section 16, which triggers reporting if you go above 10, or if you're a director or an officer. But it also triggers potential short swing disgorgement obligations, so that if you're buying and then selling within 6 months and you don't have an exemption, you have to disgorge the profit that you make from that trade. And profit is calculated in a very punitive fashion. So there are a number of ways of dealing with that. I mean, we talked about straight equity before versus, say, a convertible instrument. One benefit of a convertible instrument is that you can put something called a blocker in there. Basically say, I'll never be allowed to convert into more than 10% so that I don't trip this threshold. So you get the benefit of higher economics, higher exposure, but you don't push yourself into this regime if you otherwise wouldn't be in it, because it really can hamper your ability to get out quickly on the back end.
Okay. Well, folks watching, definitely send in some questions. Type them in the question field, and I can raise them since we have some time for Q&A. I know there are a couple court cases out there where people were playing some games with pipes and short selling the stock and stuff like that. Could you, is that something that maybe that's something the audience should hear about?
Yeah, I think the key takeaway there is if you're on the investment side, you need to be very careful about engaging in an immediate short of a pipe transaction. The SEC has brought a number of cases, and essentially what the SEC is saying is you're taking directly from the issuer in the private transaction, and then you're selling out immediately into the public market. and it starts to look like an underwriting. Now, the SEC is 0 for 3 in those cases, but I think a well-advised investor would not short their position in that way. Typically, what's done is to wait some period of time and then to use a complicated technique called the double print to cover the short position. But the key point there is take advice if you want to engage in a short. I think on the issuer side, the key thing is, do you want to restrict people's ability to short? And sometimes, again, it's very akin to a lockup. What you want to say is, hey, investors, I don't want you shorting the position, either actually or effectively economically through a swap or a similar arrangement for a specified period of time, and then extracting a covenant to that effect.
Okay. Let's see. Maybe talk about some of the trends, the market trends that you're seeing in pipes in terms of, how many of these transactions happen on an annual basis. Has it been going up, going down, and types of companies, et cetera?
Broadly defined, there are thousands of pipes every year. I think on, strategic side, I'm not sure if there's a big trend in terms of private equity firms using these. They flow a little bit with the other capital markets. There are times when debt is harder to raise, and so pipes give you an opportunity to make an investment in a company without having to raise new debt. I think you consistently see the biotech, pharmas, those sorts of strategic deals. There several have been announced this year. And then in the M&A context, those again are kind of cyclical, but you definitely see a number of M&A contexts.
Yeah, I think the order of magnitude is probably 50 billion a year or something like that, give or take a few tens, depending on just market trends and overall cycles like Bennett is talking about. I think the more interesting technique is importing some of the pipes ideas and confidential marketing into the public markets, like I was mentioning before, and larger companies taking advantage of these techniques, which maybe 10 or 15 years ago were really relegated to smaller and mid-cap companies.
Let's see. We actually have a question coming in from the audience. Question is, have pipes ever been leveraged as a path to an eventual hostile takeover, full or partial, of a company? Maybe they just gave someone a new idea.
Yeah, there you go.
I'm trying to think if I can think of an example. I'm not sure that I can off the top of my head, in part because I think issuers are pretty careful about who they bring in the investor, but I think there's certainly situations where they've led to consensual deals, where somebody basically puts in an anchor investment and then over time engages with the board and leads to it. I think, if to get to a hostile deal, and you'd have to go out past the standstill period. I'm sure there's been an example, but I think people are usually pretty cautious to put in place protections to avoid it.
Seems an unlikely avenue. Maybe a classic activism playbook would be more
the
relevant.
The long-term commitment.
Yeah, exactly.
Yeah, for a typical activist, they have other techniques that might be
more direct,
effective, and yeah, exactly. You mentioned HSR, Hart-Scott-Rodino. The other thing you mentioned that I've never heard of before is this CFIUS. What does that stand for, and how does that come into play?
I think it stands for the Committee on Foreign Investment in the United States. It's a presidential committee, and essentially what it does is has a national security mandate and allows this presidential committee to effectively veto or object to transactions that involve national security interests. It comes into play when you have foreign investors coming into industries that are sensitive from a national security standpoint. Under the current administration, that's become more of a hot topic. And so it's something that's very important to think about. And it can, in fact, scuttle a deal if the deal gets stuck in CFIUS review. Important to take advice on that.
I mean, it's the countervailing. If you're doing a pipe, you want to get the money in. You want to have certainty around it. HSR, you'd probably know if you have an antitrust issue pretty easily. CFIUS, again, as Adam mentioned, in the current administration, the focus on investments, particularly from China, into industries that are particularly sensitive, whether it's implicating national security directly or somewhat indirectly through financial services or technology. I think if you're looking at, the reality is there's a lot of nervousness in the market right now about trying to raise capital from countries that may be implicated just because they'll get hung up. The CFIUS review process these days is very slow for a variety of reasons, and so if you think you need to have a CFIUS approval, that's going to mean that that your pipe that you would have hoped to translate into real cash coming in the door in 30 days after you get your HSR approval is going to take a lot longer. And there's changes to CFIUS coming that's going to lower the thresholds for what requires a CFIUS filing. And so that's going to expand the pool of deals that people are going to look at, which again just makes you, if you're dealing with foreign investors, you definitely want to take counsel and to figure out what that means. Doesn't mean you can't do it, but you have to figure out how significant is the issue and what are the timing implications going to be. And then from the deal lawyer's perspective, you think what's the consequence and who bears the risk. I think if we represent a foreign investor, we would say, well, it's your country. We're not going to take the risk because your country blocks us. Obviously, if you're the issuer, you have a different perspective, and you'll say, if you want us to take the chance and go down this path with us, we have to have some sort of protection if ultimately you're blocked from making the investment.
Is CFIUS, is this a relatively new hurdle to cross?
It's been around for a long time. The focus on it over time, and not just with the Trump administration. It used to be you'd really worry about CFIUS in the context of if somebody's buying into a military contractor, something that was very definitely connected to the government. I think since then there was a deal blocked by like LED lights. There's obviously the Broadcom Qualcomm situation, which was blocked.
Microchips and all that.
Exactly, which is more a broad definition of what constitutes national security. It's not just defense, but it's just other strategic elements of industries. And I think
it could be aluminum or steel, I guess too.
It could be. I mean, I think this administration has made clear that steel is a matter of national security, national importance.
Any other kind of regulatory or policy developments that people have to be kind of watching that might affect pipes or that have affected pipes over the last couple of years? Tax policy. I don't know if any of this kind of impacts the pipes. Your ability or the attractiveness to investors to engage in a pipe transaction.
I mean, I think the only thing I can think off the top of my head is because of the new tax rules, it's actually now harder for U.S. Entities to own more than 10% of non-U.S. entities, because that results in those non-U.S. entities being treated like U.S. corporations for tax purposes. And so we've seen situations where people have taken their investments down below 10% to avoid that situation. So it's not dealing with probably your audience so much, but particularly if the non-U.S. Issuers may have a harder time getting big investments from U.S. companies because of these potential tax issues.
Gotcha. Okay. Well, let's see. We don't have any more questions for the audience, so I think this would be a good place to adjourn. Again, the number for the CLE, it's folks 11488. And so, guys, thank you again for joining. It's been a really good, interesting discussion here. Just want to mention to the audience that we have a couple more webcasts coming up. On May 17th, we have our next Global Benefits and Compensation Roundtable webcast that's co-hosted with Cleary Gottlieb and the American Benefits Council. In that session, we'll be focusing on sexual harassment and the Me Too movement and the potential impacts on benefit and compensation around the world. We also have another Governance Watch webcast on May 21st, where we'll be talking about SASB, the Sustainability Accounting Standards Board, and we'll have people from SASB and someone, Alan Beller from Cleary Gottlieb, who's on the big board of SASB, and someone from the Standards Board as well. So that will be, I think, of a lot of interest. We'll also be having one of our book author discussions with Adam Epstein, who recently wrote a book, The Perfect Corporate Board, a handbook for mastering the unique challenges of small cap companies. So trying to mix in our coverage small cap companies and not just focus on mega cap companies all the time. Um, and so CLE folks, 11488, put that on the form and the evaluation, complete the evaluation form, send that back to the email address listed on the screen, and CPE, please ensure that you've entered your full name and email address and specified CPE in the space provided at the bottom of your screen. Adam and Bennett, thanks again.
Thank you.
And everyone, we will see you next time.